Oh
So
gosh, right.
you guys have been chatting, but let's just start fresh here. So Jim, thanks again for joining us today. We've known each other a long time. You are the Chief Economist for Alethia Capital. Before that, you had your own consultancy called Asianomics, which I was a subscriber to for many years. And prior to that, we know each other working together as a client at CLSA for many, many years, where you are based in Hong Kong. I believe now you're living in Scotland, correct? Wonderful Scotland.
I'm living in Scotland. Yes, yes.
And I guess
Near the grandkids.
Exactly. We could talk about that later because it sounds like a lovely place, by the way. I guess what I wanted to start with, I mean, we want to focus on Asia, obviously, but certainly I would love to hear your opinion on what's happening. Obviously, things have changed in the last 3 weeks. We've got an oil shock. We've got, things are pretty out of control politically all over the world, especially here. So and I know your forecast, one of your big forecasts is for some type of global recession coming. So what has happened recently globally, and do you still believe that global recession is coming, and what's going to be the trigger? Or maybe we're seeing the trigger today, and then we could move on to Asia.
Very nice to be on the same show as you. We used to do a lot of road shows together, but this is a wee bit different. Global recession, global depression has been a kind of central case of ours really since the war started. But we went into the war in the Middle East being quite concerned about the global economy and the US economy anyway. And that was partly to do with the disruption which has taken place over the political side in the United States, and what was happening with tariffs last year, what's happening with AI, what's happening with net zero. And the one that people don't tend to talk about too much, I suppose, but I think is the most important of all, and that's fiscal dominance or fiscal dependence, especially in the industrialized world, in Europe and the United States, where you're beginning to see a breakdown in terms of the responses in bond markets to signals from central banks. In the United States, there's been 3 interest rate cuts in the last 12, 15 months, and the 10-year Treasury yield is up over that period. Obviously, the 3-month is down in line with the interest rate cuts, but the longer end of the bond market isn't. And I think these are beginning to tell us that when we're looking out 10 years, America, or the United States, Europe are in deep, deep trouble as regards the contingent liabilities that have been built up over the last 50 years by politicians promising the earth to old age pensioners like me. Because basically we're not going to be able to afford the pension payments and the social benefit payments that everybody expects nowadays in the industrialized world. Actually, it's what makes me really excited about emerging markets, but that's something that we can obviously focus on in a bit. But fiscal dominance, and then you add in all these other disrupting forces, and what we were saying going into this year was that when you look under the bonnet of the United States economy, last year, despite all the talk about reindustrialization and the like, the US shed manufacturing sector jobs. Manufacturing sector jobs were down last year. The other thing that has been a kind of focus of our attention is that not just in the United States, but in Europe and certainly in the UK, where I am, the skills profile of these economies doesn't allow for a reindustrialization policy. That's just going to become an absolute brick wall. We don't have the skilled labour force that we used to have when I was growing up in terms of manufacturing and industrial skills. They've gone to China, they've gone to other parts of the emerging universe. But that just makes me very uncomfortable about strategies that require us to believe that there's a heterogeneous labour force and heterogeneous capital base in our economies. There isn't anymore. So we were going into 2026 saying that there was going to be a significant slowdown. The disruption would raise uncertainty, and that would lower investment. That was our kind of main theme. Then everything broke loose in the Middle East, and that's just raised the game dramatically in terms of the disruption process. And it's not just about the politics and the truth social tweets every day that seem to point in different directions by the minute, which of course is further uncertainty increasing. It's the real effects of not an oil price shock, because that's handleable. That's not a problem. It's an oil supply shock. And I think we're only at the very beginning stages in the last week or two of finding out what those supply shocks are actually going to do to production and to capacity in various countries around the world. The last tankers from before the war started have now reached Europe and Southeast Asia. And from here on, it's a big question mark about the ability of some of these economies, not just to meet their growth targets for this year, but survive.
Yeah, Jim, what I see, the two things that for me really have driven this period of, you can call it American exceptionalism or whatever, but this past over 10 years now, 12, 13 years of really U.S. dominance have been the shale oil boom and Silicon Valley, right? I mean, there's just two huge drivers that I don't think people, pay enough attention to. And I mean, that sort of continues, right? The shale oil boom may be at its peak or so, but it's still providing a huge advantage to the U.S. relative to the Europe or China and Silicon Valley just seems to invent something new every couple years, and now it's AI and it's driving. And so, doesn't that story stay intact? The U.S. is just so well positioned in terms of energy and frontier industries that at least relative to the rest of the world, it's very well positioned.
Yeah, that you're right, Jean, and especially in terms of the oil profile at the moment. You mentioned shale oil, West Texas Intermediate. Bear in mind that, of course, not every barrel of oil is the same. The US dominates in terms of sweet crude oil, which is tremendous for some oil products. It's not so good for others. And the US is actually a big oil importer of heavy sour crude, which is then broken down into obviously some of the heavier components like diesel and what have you. But that's pretty important for the US economy. So it's definitely a lot more immune than it used to be. It's got a lot more oil than an awful lot of other countries. And so that puts it in a better place.
Venezuela sort of gives a supply of heavy crude, right? And that's Trump's personal business over there. He's taking it over.
That's right. That's indeed right.
He's running the country.
Yeah, and he's certainly running the oil industry, and that is a big beneficiary. That for sure for the United States. That's a big supply of probably the heaviest and sourest crude. But the AI thing and the Silicon Valley element, yes, very, very important, because if you stripped out the integrated circuit investments from last year, looking at the investment components of GDP, if you strip them out and some of what they now call intellectual property products as a component of GDP, investment in the US would have been down almost double digits last year in the rest of the economy. I mean, that was the absolute feedstock to the growth of the US economy in 2025. Now, one thing just to bear in mind, it was a chart that we put into a publication quite recently. if you're looking at the post-COVID period, and we were taking 2023 to 2025 as being the post-COVID period because China didn't come out of it until 2022, late 2022. On average, US growth over those 3 years is 2.6%. Last year it was 2.2. Despite everything that was going on with AI and that huge concentration on AI as a driver, actually the US underperformed last year relative to a lot of countries. I was looking obviously at Asia more than anywhere else, but a lot of countries in Asia which were actually outperformers. What we also tried to do at the end of last year was have a look at the assumptions behind the continuation of the AI boom, and in specific terms, the hyperscaler investments in data centers. And I spoke to a few people involved in the electricity industry in the United States, just to get their take on the demands that were about to be placed on them and placed on the grid in order to fulfill these investment plans. And, they just laughed at me. They said, there's absolutely no way that we can handle the amount of demand for data centers in terms of supplying them electricity. And there's no way to increase this in anything other than a decade-long timescale. One guy said to me, the US has had 4 trillion, 4,000 terawatt hours of generation capacity for the last 20 years. It's hardly changed. And what they're talking about is adding another 800 in the space of 5 years. So he said, as long as they can build 80 to 90 nuclear reactors to feed into the grid, then we're fine. But without that, this is just pie in the sky. And then he went on to all sorts of reasons as to why we don't have the skilled labour force either in the US or anywhere else in the industrialised world to fulfil these promises. So that was where we were coming from in terms of things were going to slow down this year.
Why do you think the market is missing this? Because I've heard this commented, pretty frequently, and it seems relatively obvious, but the market doesn't seem to care about this. Is it because there's just an assumption that technology will solve everything, or what do you think?
So, and in fairness to that assumption, it quite often does. Technology is brilliant at adapting to difficult circumstances. We've found that time and time and time again through the world economy. But I think one of the biggest failings is really from my own profession. Economists have fed the world stories about how it works for the last 30, 40 years, which basically make the assumption that everything is homogeneous. So that there's this huge pool of capital out there. And people then immediately start thinking, oh, dollars, money, capital. But I'm not talking about capital as in the amount of money in the system. I'm talking about physical capital, whether it's factories, infrastructure, bits and pieces, actual physical things. The assumption that economists make is that all of that capital can be instantly, what would you say, deflected or addressed to a specific area of production. And it can be done seamlessly. Now, this was an assumption that basically underpinned the whole Keynesian revolution back in the 1930s. At the same time, there's an assumption that, we've got, let's say, 5% unemployment. We're going to have a significant increase in the demand for welders, let's say, or plumbers. And from that 5% unemployment, we'll easily get the number of people that can weld and can plumb. And this is just garbage, utter garbage. The only way, in my view, for example, all of the data centers in the United States that are planned and want to be built and manned and maintained is if you take the physical capital from China and bring the workers with it. Then it's possible, because that's where the excesses of capital and workers, very specific capital and very specific workers, exist.
The Mag 7 are investing like trillions of dollars per year in these data centers. Do you think they're just doing their math wrong? They don't understand this issue? Or I mean, they must have decent planners, no? Or
and given that we all plan, but basically we all plan for our own household, as it were. We don't really look around and say, oh, he's doing the same as me and he's doing the same as me. Therefore, I shall not do what I wanted to do. Nobody does that. Companies basically say, I'll do it better than him or her, and I'm going to get on with it. But when everybody is saying exactly the same thing, that's when you start to hit the bottlenecks. I just don't think we've quite hit the bottlenecks yet. Now, having said that, there are, and again, going back to the conversations I had with these American-based guys who are in the electricity and steel fabrication industries, they were saying that a number of these data centers have between 5 and 7 years waiting lists to actually be connected to the grid. Now, you might be able to bring generators in and things like that to help the story along a bit, but that's going to be very inefficient and not certainly enough power to keep it going properly. And then, of course, we get data centers in the Middle East that have now been bombed out of existence. Data center plans everywhere else that are going to be in competition with these things. All I would say is that I'm quite certain that everybody is smart enough and wants to do what they've said they want to do, and all of their capital investment plans are genuine. But what they're going to find is that if they were all actually enacted, there would be no return on the whole investment. It would just be massive overcapacity.
Yeah, I mean, Jim, one of the interesting things we talk about emerging markets, skipping here, is that ByteDance, for example, they decided to invest in Brazil. So they've committed, they're building a $40 billion data center in the northeast of Brazil, where there's plenty of cheap energy, no worries about environmental permits, which is the biggest problem here in the US, is that the communities don't want these data. They think these data centers are going to fry their brains. So like, there's no way they're going to build these things here. There's too much. But at places like Venezuela, they don't care.
Funny thing, Tom, was it wasn't even the fry your brain stuff that was bothering the guys that I spoke to. They were just saying the transmission lines. There's no way they'll get planning permission to take the transmission lines from the grid to the data centers. That's something that in the United States and in a number of other countries just takes years and years and years and an awful lot of opposition. So yeah, I think you're right. And the emerging markets actually are going to be big beneficiaries from the data center thing. I was saying to John earlier that I've just come back from a trip to Asia, and I was in Malaysia. Now, it's really interesting because there's data centers going up in Johor, which of course is right next door to Singapore, and the relationship between Malaysia and Singapore has improved dramatically since Lee Hsien Loong left office in Singapore and Mahathir left office, although he's still around, in Malaysia. The two countries have come an awful lot closer together. There's going to be a train link between Johor and Singapore that's opening at the end of this year. When I say a train link, I mean an underground train link, the MRT system. So there's huge potential for trade-offs and for interaction between Singapore and southern Malaysia now. But what's happening is that those data centers are going into an electricity-rich area already, although they would demand an awful lot of electricity. And what Sarawak, which is miles and miles away across the sea in not even Peninsular Malaysia, but in Borneo, it's laying an undersea cable to Johor to pipe the electricity from the Bakun Dam, pure renewable water, hydro, straight into Johor. So you even avoid the environmental issues, because of course in a lot of developing countries and emerging markets, it will be coal-fired power stations that would be the main source of the steady electricity. In Malaysia, it's hydro. There's big beneficiaries coming, and I think a lot of them are in the emerging markets.
Yeah, Jim, you also on your trip you went to China, and when I read your report, you mentioned five sort of points that are getting you more, let's say, I hate to use the word bullish, but getting you more excited about China. And I guess if you can go through those, I thought they were very interesting. Saying, one was better placed than others. You talked about Taiwan, which I think you are spot on with Taiwan. The growth plan, and obviously the big one, the two big ones are property bottoming, and then something that we've talked about a lot on the podcast is the China dumping. The exports are just rolling right now. Can you talk about the conversation about China and what you saw there and why you're more optimistic than most?
The funniest thing as well, Tom, was that I go to China at the same time every year. As you probably well know, the National People's Congress meets in March every year, and that's when the government gives its account of what's happening, and the Prime Minister presents his work report. And it just so happened that this year as well was the start of the next 5-year plan. So this is the 15th 5-year plan. So that's always a big year as well. But I go every year, and the difference from last year to this year was, I just felt astonishing. Last year, everybody was downbeat. People I've known for years, and I don't speak to market people when I go to the various countries. I'm speaking to industry people, I'm speaking to academics, I'm speaking to economists that are not in the stock market, might be in ratings companies, or basically, as I say, academic, or in China, the social science people. Last year when I was there, two people that I've known for many, many years turned around and said to me, I'm really worried about a war with Taiwan. And at the same time, they were exceptionally concerned about the impact of tariffs and about economic growth in China as a result of that. And property was still an overhang, but a kind of secondary issue, to be quite honest. This year, my goodness, I eventually I was getting to the point in meetings that I was saying, and what about Taiwan? Nobody mentioned it. Nobody. And whenever I did mention it to them, they said, oh no, prospects are looking really good. It's going to be a much more collegiate type environment going forward. There's no reason for anybody to be concerned about Taiwan. And part of that, I think, was the timing from a Chinese perspective. I mean, Xi Jinping has got a few things to get right over the course of the next year before he's potentially reconfirmed as leader again in 2028. So he needs to deliver quite a lot. His attention is on the domestic economy. He's also got rid of an awful lot of generals, so I'm not very sure that there's any generals left to coordinate an invasion of Taiwan. But maybe that's being unkind. But the other thing was that, again, very simply, that you look at the election results in Taiwan, and I've always thought this was the case anyway for China, that they don't tend to look 6 months out and say, we've got a problem to solve here. They're going to say, what's it going to be like in 2 or 3 years' time, if not 5, 10 years' time? In the last election in Taiwan, the DPP candidate won the presidency on 40% of the vote. Now, in most other countries, when there's splits in terms of the number of candidates in the poll, usually the top two will run off against each other. Not in Taiwan. So the two parties that are actually quite closely aligned as regards their attitude to Beijing, which is constructive, are the TPP, the Taiwan People's Party, and the Kuomintang. They set candidates up against each other, and they split the anti-DPP vote. So between the two of them, they get 60% of the vote. The DPP, William Lai, got 40%, but he was elected because they managed to split it so well that they didn't beat him. Nobody beat him. This time round, there's the woman who has taken over, Cheng Li-Wen, came to Beijing a week after I was there, and everybody was looking forward to that, and she was really treated like royalty when she arrived. So there's definitely I think an understanding now, and certainly from the Chinese perspective, they're not going to even think about Taiwan as an issue over the course of the next 2 years.
Is that because the perception is that the U.S. is no longer a reliable partner? And if you have that perception and you drift towards China, is that what's going on, you think, throughout Asia?
Well, Taiwan maybe not at the moment. William Lai certainly wouldn't be on that boat. That's the DPP guy. But the Kuomintang woman, yes. And around Asia, you're spot on, Jean. Around Asia, from the people that I speak to, nobody I would say is saying China's a great guy, everything's fine. There's lots of problems with Chinese investments and Chinese overreach, if you like, in countries within the region. But the attitude towards China has changed substantially over the last 2 years, where people see what they think and believe to be a reliable partner, at least in a trading sense, and in a stability sense, and they want to be closer to that partner. And they look across the Pacific Ocean and see what's going on in the US, and they're basically just saying, "Oh my goodness, that we don't know what to believe and who to trust," and that has been a big feature in the region over the course of the last 18 months. But going back to Tom's kind of other questions, yes, the 5 issues that you mentioned, Taiwan aside, most of them domestic. We'll come to exports just in a minute. But the 15th 5-year plan was a big signal to a lot of the actors in certainly the economic circles in the Chinese economy over the course of the last 6 weeks, because what had been top of the list of their concerns, the government's concerns, a year ago, was local government debt and local government finances. Remember, local governments are very important in China because they tend to be business development organizations. They'll finance people from the private sector or sometimes the state sector to get on with doing things that have been signalled by Beijing. This is where we should be aiming the economy, but those guys get it moving. So last year there was a real concern about the ability for local governments to continue to do business, as it were. local governments have gone from being top priority in the Beijing list to bottom, number 10 in terms of priorities. That means we're fine. We don't think there's a problem anymore. They transferred a lot of money to local governments last year, I think partly to pay wages, to get them back up and running a wee bit. The property market, which links into this, obviously that was a big financer of local government funds, because land sales were the key to an awful lot of their finances. Property is still problematic in China, but you know what I've tried to say to people over the course of the last number of years, that there's never been a crisis in the property sector in China, because governments, when they're faced with crises, immediately do something about it. They'll throw the kitchen sink at a crisis. This was deliberate policy action playing out over a number of years. Now, I think they've achieved what they wanted to do, which was A, to teach a lot of bad actors in the property development side a lesson, and B, to consolidate the whole construction and real estate industry into something much, much smaller, because it was just too big a driver of the Chinese economy. They actually signalled in September 2024 that they had basically done it. And then they had another bad year in 2025. But again, there was no sign of panic, no sign that the government was going to say, oh, we need to sort this problem out. And now there are some green shoots, and especially places like Shanghai, that the property sector's turning round. I don't think that the leadership in China want the property sector to boom in any way. I think if it just flatlined, they'd be quite happy. But that would also be something of a signal to people who have a lot of savings in the bank in China at the moment, to maybe start putting those savings to work, not necessarily in property, but maybe in equities, maybe in something else. So this is pushing in the right direction. The 5-year plan, the big focus was on what they call high quality, high speed development, which is obviously technology, integrated circuits, biotechnology, the low altitude economy. I think they're going to have drones all over the place in China, as far as I can make out. But areas, again, that people have already seen and have had demonstrated to them that the Chinese are pretty much at the forefront. So there was a big upsurge, I would say, in economist confidence in my visit this year. The tariff worries and the like, they think that Trump is just too concentrated in the Middle East to bother with that anymore. Who knows? That might be a mistake, but that seemed to be the case. On the export front, yes, I think an amazing, what would you say, achievement last year was that the Chinese exports to its biggest market, the United States, fell 20% year on year for the full year. And yet overall Chinese exports went up 5%. And this wasn't a price effect. I mean, prices are changing now because of what's happening in the Gulf, but this was in a pretty calm price environment. So this was a volume effect. And really, when you look at it, Tom, the most amazing thing is that the stability of Chinese prices, and what everybody claimed to be a major problem for the Chinese economy, a degree of consumer price deflation. What that did for Chinese competitiveness, when you take into effect the real effective exchange rate against all its trading partners who did have much higher inflation, including the United States, the renminbi's never been more competitive. And with that, it displayed tremendous market gains across the global south and into the industrialized countries as well. It's just gigantically competitive.
Jim, how much of the 20% decline of exports to the US just gets rerouted through Vietnam or whatever countries?
So the transshipment, John, obviously there must be an element of that, obviously. And one of the charts that we've reproduced a number of times for clients is Vietnamese exports to the United States and Vietnamese imports from China on the same chart, because it's the same line. So there's... But, you know, at the same time as saying that, and that's being a wee bit flippant, because the truth of the matter is that there has been a lot of investment flow from China. And again, I go back to the idea of heterodoxy and heterogeneous rather than homogeneous. We use the words exports from China as if it's all Chinese companies owned by the government that make the exports. Whereas in actual fact, it's companies from all over the world that were based in China that then produced the goods and exported them to various companies and various businesses and various consumers around the world. So just as a prime example of that, the Apple iPhone is actually an American company. I don't know if you know that, but it was made in China. Now it's actually made in India. But that would that be considered Chinese transshipment because they changed their production facility to India? It wasn't a Chinese company in the first place. It was an American company. It was still an American company, and quite a lot of the Vietnamese stuff is like that as well. So it's not just a China transshipping story, but there must be some that for sure.
How do you see the what people call now the China Shock 2? This extremely aggressive Chinese exports that you could call dumping in many cases, that are really undermining industry throughout the developing countries, throughout emerging markets, Brazil, all of Latin America, Southeast Asia. Is that a big problem for Indonesia, for Thailand, for Malaysia? Their entire growth model was always based on exports, and now they're completely undermined.
Well, and I mean the Chinese companies are not just going there to produce exports to then replace exports from these companies. They're actually producing goods that are sold domestically. So I heard from one Indonesian friend that was saying that bread products, I can't remember the name of the company in Indonesia that's it's like Gardenia in the Philippines, but I've forgotten the Indonesian company's name, is now being undercut by Chinese bread producers. I mean, incredible. So it's a problem. And it does leave a lot of countries and a lot of governments in a difficult position about what they do, whether they have to try and raise barriers domestically to some of the Chinese products. At the same time, a lot of it will sort itself out, because although the anti-involution story, I mean, why the Chinese have to invent complicated words for what is actually just internal competition, I don't know, but they did. So the whole idea of the anti-involution was to allow the competition to happen internally in China, but for the bad companies only to go bust slowly rather than all at the same time. So eventually the good companies and the good actors are going to win in this story anyway, and the bad faith actors and the guys who are desperately trying to get market share and the like are going to go bust anyway. But it just takes longer than it really should take to shake out, as it were. And that I would say is a criticism that we could level at Beijing, and it would be a legitimate criticism. It won't work. It never ever does work when governments try and protect industries and slow down the creative, destructive process. It's ultimately backfires. But in the meantime, there's a lot of people that are having pain as a direct result of it.
Yeah, but meanwhile, the industrial base of these Southeast Asian countries is being destroyed now, and once it's destroyed, I mean, it's very difficult to recover it.
Yeah, I mean, there's elements of yes. There are some countries where, unfortunately, I'll give you an example in a second. The industrial base hasn't really moved in the way that it should have to, if you like, protect itself against Chinese competition. And that country I'm thinking of at the moment is Thailand. Thailand, up until very recently, was probably the biggest automotive parts producer in Asia, and then into the rest of the world. But those parts were all for ICE cars, internal combustion engine cars. So the Japanese have tremendous component parts and assembly lines in Thailand. Some of the European companies have them as well. Thailand was kind of asleep at the wheel as electric vehicles became the big thing. Now, of course, as we all now know that I would be able to fix anything in my car anyway, but the ICE component parts of a car engine are something like 2,000 different moving parts and nuts and bolts and the like, whereas electric vehicles, it's just a big battery. There's very, very few component parts. So some of these industries were going to go anyway, Jean. The Chinese are not even trying to compete with the Thais in terms of petrol and diesel engine cars. They're just invading with EVs. And they're selling them domestically. And yes, that does mean that those industries are going to go, which is now the next question for Thailand. How do we, what areas do we focus on that people and companies will have better businesses than the Chinese? So there will be things. But, remember, China is actually very short commodities. It needs to import most of its commodities, whether that's oil, but including all the metals, even the rare earths. I mean, they just they bring the raw earth in and just put them through the processes to actually extract them. So
Jim, is it possible that these Southeast Asian countries have entered, the middle income trap? That that they're no longer high growth countries. They're sort of, they have bad politics. They can't compete, and they're starting to look like Brazil.
It's a different story from country to country, Jean. We can't lump them all together. Vietnam is just extraordinarily just now. But the funny thing about Vietnam, and I was saying this to some of my Indonesian friends when I was in Indonesia, if you're a foreign direct investor in Vietnam, you can get anything done for your company and for the employees and the business environment. The government has gone out of its way to support FDI instead of domestic investment, which is, I think, kind of short-sighted. They're now trying to swap that a wee bit. But in other countries where, for example, Indonesia has been, I don't want to put, I don't want to annoy anybody that might be listening from Indonesia, but it is incredibly xenophobic when it comes to dealing with foreigners. Indonesia's kind of main attitude has always been that the foreigner is out to get me. And that includes the Chinese, by the way, of course. But so they've protected their domestic industries. And it's quite interesting at the moment because Danantara has come into being, and part of its remit is actually to to try and rationalise and consolidate the 1,004 state-owned enterprises that dominate a huge amount of the landscape in Indonesia, both in manufacturing and in construction and services and the like. So there's a degree of inbuilt uncompetitiveness and protection in some of these countries. And unfortunately, that's now going to be badly exposed. And where they go from here, I don't really know. I mean, again, I go back to the good thing. Indonesia is a huge commodity producer. Commodity producers, and I mean, Tom will be, I'm quite sure, on top of this in terms of the Latin American guys. Commodity producers for the next decade are quids in. I mean, this is one of the reasons I'm actually quite excited about emerging markets, even though there are political issues, there are some short-term problems in some of their manufacturing sectors and the like because of competition. But anybody that's producing commodities and who can then start to downstream some of the commodity elements is going to be in a fantastic position for the next 30 years.
What we see though is a country like Brazil, every commodity boom, blows up and makes things worse than it was before. So it's good.
Oh.
It's good when it's on, but then when it's over,
Jean, and of course, what it is that more often than not, what governments and what the political class assume during a commodity boom is that it will carry on forever and it'll just keep giving and keep giving. And quite often it gives to the government, which then distributes it in a very inefficient way across the country. I think this boom is actually going to be pretty astounding in historical terms going forward. I mean, when I think about commodities like copper, which is just going to be, people are going to be searching for it everywhere. But the important thing then is for the miners, the production facilities and the enrichment facilities to be built and to be encouraged by domestic policies, so that there will be a retained, recurring demand for the products from that country, and for those products to be not just sent out in the form of bauxite or copper ore or whatever, but actually converted into much more useful byproducts. That's, yes. I know that sounds as if it's never happened before, but this, I think, will be different. This will be different because it's going to be longer.
Yeah.
I mean, when you look at, Jim, when you look at, let's say, your forecast for a slowdown, which may come to pass, because I think everyone in the U.S. believes that the political situation here is going to get really rocky towards the end of the year and into 2027. It's clear that we're going to have political stagnation. But then you talk about the dollar, right? And you talk about commodity prices, and with, let's say, if the U.S. does go into some kind of slowdown, that normally would hurt commodity prices. But with obvious dollar weaknesses, it'll have the opposite effect. You could see a U.S. scenario, higher inflation with slow growth. I mean, just really dire. But in that situation, how do you think emerging, and then Europe's going to be in even a worse condition, but how do you think emerging markets can, for the first time, I think could like thrive in the midst of developed markets being kind of weakish? Like, how does your scenario on EM, especially Asia?
Yeah, it wouldn't be the first time, Tom, because remember back into the late 1980s and the early 1990s, the industrialized countries in the US in particular, actually the US in 1990-91 had a mini recession and that was after the 86 or 85, 86 recession, various problems in savings and loans and what have you. There have been periods where emerging markets have thrived during relatively slow growth in the industrialized countries. Now, of course, China wasn't an issue at that time. And India was kind of closed off as well. That's something we haven't talked about, but these are two big countries who actually import a lot of things, both of them. So as long as those countries are still functioning, the other emerging markets have a big chance, if, of course, the dollar is weak. And admittedly, that's my scenario. My forecast for the beginning of this year was that by the end of 2026, the dollar would be at 90 on the DXY. I think we're currently about 99. It was about 96, so I was only looking for 6% down or whatever, but it's now 10%. But that's before it goes to 75. And that's where I think we're headed with the dollar. Why did I say 75? Well, that would be the lows of 2008, 2015, because I think that's the nature of the kind of crisis that is likely to engulf both the US and Europe. Now, the big problem, of course, is if the dollar's weak, you need something else to be strong, by definition. And personally, I wouldn't touch a euro with a barge pole, but it tends to be quite a big component of the DXY, apart from anything else. But there's two standout currencies in Asia that are just going to motor over the course of the next 5 years, as far as I'm concerned. The renminbi, that might not come as too much of a surprise. As I said, China's tremendously competitive anyway, so a 10-15% appreciation of the renminbi just wouldn't be troublesome for them. But the other one, which I think is going to surprise everybody, is the yen. And I think the yen is probably headed back to 115 rather than 165, which is kind of part of the forecast just now. You know, believe it or not, it's less than a decade ago that the yen was at 115. Everybody just thinks that it's going to slide forever. Well, I think the Japanese are going to be forced to increase interest rates and increase them really substantially. The bond market's already doing it for them. The carry trade is eventually going to become very unattractive, in my view. And with that, there's going to be a return of money to Japan. There's going to be a sell-off in that carry trade from everybody that's borrowed in yen. And the yen's going to just go through the roof. And there's going to be the two currencies that I think are the major beneficiaries of a weak dollar.
Do you think that the Koreans and Taiwanese and the Chinese would have to go along with the Japanese? It would become a regional trade?
Good question, John. Actually, you know, the Korean won has been strong in the last year or so. I can't remember the exact percentage, but it's up substantially. The country that you need to declare no idea on, and that's my honest opinion, is that the Taiwanese have been the biggest cheats in the global economy for decades.
No question. They have like the cheapest McDonald's burger in the world. So it's ridiculous.
It's ridiculous. I mean, their current account surplus is 15% of GDP. 15. You know, any other country in the world, if it wasn't a close ally of the United States, sitting next to China, and we all hate China, the US would be bashing them with a sledgehammer, saying, you guys are just stealing money from us all. And they are. They have been for donkey's years. But, you know, the other thing is, I've just, as I mentioned earlier, come out of Malaysia. The ringgit's under 4. A year ago, it was 480. You know, these currencies can move. The Thai baht, which I must admit I don't quite get. Malaysia, I get. I think Malaysia is looking really, really good just now. Just not enough bandwidth in the equity market to play it. But the Thai baht, which is also strengthened, I can't quite understand. But there are currencies, and they help the dollar valuation of their stock markets that are doing really quite well, and are going to continue to do very well in the environment that I foresee anyway.
Yeah. I had a question on Vietnam. Vietnam is a communist country like China, in many ways very similar to China in terms of governance. China has had very high growth for 30 years and no performance in the stock market. I think that's because of the model, right? It's because of the governance model. Is Vietnam going in that same direction? Is it going to be a high growth country with a terrible stock market performance?
It's had a very bumpy history so far. There's things that just seem to come out of the blue in Vietnam to really scupper the stock market. So the latest one was the corporate bond scandal in late 2020. Was it 2023? I think it erupted, and that was turned out to be a property group, and the woman who ran it was eventually convicted and sentenced to death, but she hasn't been shot yet. The Chinese would have done that the next morning, but Vietnamese take a bit of time. But that was left field. Their danger is falling into the same trap as the Indonesians, which is now coming home to roost in Indonesia quite badly. That the free float is not a free float. There's much more in the way of concentrated company interests, family interests, state interests that own the shares of these companies. And that then gets the ire of people like MSCI, quite rightly. And they're about to potentially downgrade Indonesia from emerging market to frontier status. Wouldn't that be just astonishing after 30 odd years of being an emerging market? But that's always a danger, Jean. And I think I couldn't, hand in heart, even though we've got a global long on Vietnam, I couldn't hand in heart say to people, you're safe in Vietnam. There are too many instances of just something coming out of nowhere that knocks the stock market. Over time, it's actually done not badly. And it's better run now in terms of monetary management than it was in the past. But it's still got some weaknesses.
Jim, this has been awesome. Before we go, I need, as always, because it's coming up soon, give us your predictions of the World Cup, Jim. Who are you? I think I know.
Where's it being held to? Well, for the first time since I think it's 1994 or something like that, Scotland have managed to qualify. And of course, who do we come up against but Brazil in the first group? I can confidently predict that Scotland won't win the World Cup. That's an absolute certainty. I can confidently predict we probably won't get out of the group either. But that would be par for the course. I shall be supporting the team that I always support in every World Cup because it's the most entertaining football team ever on the planet, and that's Argentina.
Argentina. I knew you were going to say that.
Argentina. Yeah, go Argentina. And they've got a libertarian as president. What's not to like about them? I'm not quite sure about his singing and dancing in Tel Aviv, admittedly, but still.
Jim, thank you very much. It's been very helpful. This has been awesome, as always.
Pleasure. Good to speak to you. Great to see you, Tom. Nice to see you again, Jean. Great. Bye.